If you're looking for dividend stocks to buy now for the long term, delivering through on plenty of growth, whether that's share price appreciation or just dividend growth itself, I have you covered today with 3 dividend stocks that I myself am insanely bullish on and want to put on your watch list. So, are you ready? Now, as of this video, we're in a very interesting point in time with the Federal Reserve having just cut interest rates, which has been the moment we as investors have all been waiting for. Now, that's going to allow businesses to get back to spending without restrictive budgets and also allowing consumers to ease up on their budgets as well. However, the latest now in terms of news headlines points to a recession, which I am sure now will be the only word you're going to be hearing from media outlet to media outlet. Yet the real key is to grapple with the macros to understand, at least in the near term, where to look for undervalued stocks, but remain long on each of the investments that you're looking into. And as long as you're sticking to bulletproof pieces of investment criteria, which in my book comes down to companies with strong leadership teams that are on the forefront of pioneering their respective industries, along with popularized or well-known brand names amongst all of us consumers, and most importantly, companies with clean balance sheets, meaning little to no debt, there's zero reason why now is not the perfect time to just keep investing. So with those pieces of criteria in mind, I was able to dig up 3 opportunities to put on your radar. Now, I'll let you know that these are dividend growth stocks, meaning the dividend yield isn't the wow factor here, but over time, you're going to reap the benefit of share price appreciation and a growing dividend to ultimately yield you more money while not having to worry or think twice about your investment. If that sounds good to you, let's cover the first pick, Rockwell Automation, ticker symbol ROK, which has likely flown under your radar, but nonetheless, a company focused on automation and digital transformation services throughout North America and Europe, as well as a growing presence now in other regions of the world. It operates through 3 segments: intelligent devices, software and control, and life cycle services. Now, part of the reason that I remain keen on Rockwell is because we're only heading into a more technological advanced future, and companies are going to need the assistance while modernizing. But bearing in mind our economic environment of this past year, well, Rockwell and similar companies were not necessarily well positioned to perform as they should have been, with a lot of companies cutting down on their budgets, which ultimately hit on their sales. And now we see Rockwell down by 15%, trading for $258 per share. Click to the 5-year window, and we'll go back to 2021 to see less restrictive times and how Rockwell performed pretty well. Up over 55% there, hitting on the max view here, only a hike worth of greenery as well. But ultimately, it's going to come down to the financials. So let's scroll down to see revenue year in and year out notching up, with over $9 billion brought in back in 2023. And in terms of the balance sheet, I would like to see a larger difference between assets and liabilities. Given the nature of the company, I do, however, give it a thumbs up for what it looks like as we speak, quite clean. However, we are here for the dividends, so let's go ahead and click into Simply Safe Dividends to see a safety score of a 70. Not too shabby there with a 1.94% dividend yield. We can scroll down here to see some more metrics. 21 years worth of a dividend streak without reduction, as well as a payout ratio coming in at 45%. Now, we also have a solid dividend growth rate with Rockwell coming in at 10%, and Rockwell being a qualified dividend stock is only helpful and beneficial for us all of which leads to a reasonable valuation here according to this team at Simply Safe Dividends. But if you're finding Rockwell to be a small player in the industry and a bit too risky for your portfolio, you can stay in the same wheelhouse yet enjoy more comfortability with Accenture, ticker symbol ACN, which provides strategy and consultancy services for digital transformations, DevOps, application modernization, enterprise architecture, software and quality engineering, data management, as well as a ton of automation services. It's pretty similar to Rockwell, but we could see that it's been at least in a better position and had a stronger bounce back this past year, only down by 3%, trading for $337 per share, yet with room to climb back up to $370 per share. Clicking to the 5-year view, we could see a company that delivered through on over 76% worth of appreciation, and hitting into the max view, we could see well over 1,700% worth of appreciation. Now, in terms of the financials, a growing revenue stream with much more revenue flowing in as a larger powerhouse in the consultancy business, bringing in $63 billion in 2023. In terms of a balance sheet, like I said, a bit of a safer play here with larger splits between its assets and liabilities, as liabilities come in year over year at about half of its assets. Now, in terms of Simply Safe Dividends data, you're going to see another safe play with Accenture with a dividend safety score coming in at 92 and a current yield at 1.53%. Scrolling down to your key metrics, we have 18 years worth of a dividend streak, a payout ratio coming in at 43%, 15%, which is a sweet spot in my book, allowing us to enjoy growing dividends over time at an average growth rate of 10%. And again, another qualified dividend here, which is great for us, and again, looking reasonably valued according to the Simply Safe Dividend team. Now, investors, 2 down and 1 more to go, but before I cover it, I need your help with a personal goal of mine. I'm actively trying to work on getting the 70% or so of all of you who aren't yet subscribed but keep tuning in week after week to officially join me here on the channel by subscribing. Now, I can't subscribe for you, but if that's you, someone watching and not yet subscribed, it would mean a great deal to me to earn your trust and support as a subscriber. And while you're at it, tap on that thumbs up button just to let me know that content like this with stock ideas is what you're looking for. So with that, we'll get back to it with the last stock that I have in focus. It has been a stock I've been focused on all year long. We have Visa, ticker symbol V. Now, I'll be short with this one. We're talking about a transaction facilitator that earns all of its revenue by collecting fees when you or I use our credit cards. And of course, it's staying away from all the risk of lending, leaving that to the bank. So for a moment, just think to yourself as a consumer. First of all, are you using a Visa credit card? But second of all, how many times a week do you actually spend? Or in some cases, daily. Now, in my opinion, there's zero reason why we all shouldn't have a stake in a power player like Visa. And especially now after the stock just tanked, as we can see, it's down by about 7% in the last handful of days here. Yet big picture, a powerhouse in terms of appreciation, as we see over 54% worth of it over the last 5 years. But what exactly happened? Why did Visa crater the way that it did? Well, the DOJ, or rather Justice Department, is accusing Visa of stifling competition, thus throwing Visa into the antitrust lawsuit ring, spooking away investors. But this is now where the opportunity lies. Investors, it's all about the long term. And given the financials are just way too beautiful with revenue numbers that just continue to climb year in and year out, right down to the company's balance sheet with assets that continue to hit higher highs while liabilities remain in check, I'm extremely bullish on Visa and personally continue to actually invest in it week to week. But here's where I really may get some upset dividend investors. If we click into Simply Safe Dividends, Visa scores a 99 in terms of safety, yet only touts a 0.77% dividend yield, which personally, for someone with decades to go in the stock market seeking total return over passive income that I don't need to collect on right now, I think is actually a perfect fit, especially as I see 18% worth of a growth rate, while the company has been at it now for the last 15 years worth of a dividend streak. And mind you, Visa has only a payout ratio there of 22%, which makes it insanely safe in terms of a growth run, but also a qualified dividend player we have on our hands to enjoy. So again, just another undervalued stock as per the Simply Safe Dividends team. Investors, Rockwell, Accenture, and Visa are where my eyes are as of now. Let me know your thoughts on each of these dividend stocks or which opportunities you're most focused on. Comment down below in the comments. Be sure you're subscribed, and also be sure to join me and the founder of Opal Capital for an in-depth talk on dividend stocks here.